Okay, here we go again. We're in part three now of the midterm exam review, and I apologize for kind of jumping around between topics here, but uh, just want to make sure that I've covered the basics that you can expect to possibly see on the midterm exam. Uh, so there might be a little bit of overlap between uh, chapters as I've been blathering on here, but so just to review some of the stuff in chapter three that I didn't talk about before, so I don't give you the idea that these won't be on the exam. Of course, in chapter three, we went through journal entries. We went through basically the cycle of a transaction, what that means in terms of an economic event and how it needs to be recorded in the books of account via a journal entry and then a posting to the ledger. So those amounts that were in the journal entry get posted to their separate accounts. Then we went through the trial balance and how that must be prepared to show that overall debits for all the accounts with debit balances equal all the credits for all the accounts that have credit balances. Excuse me. Then we discussed in chapter three cash activities in terms of investing, financing, and operating. So you should understand examples of each that basically come out of the statement of cash flows. Then moving to chapter 4, and we've already talked about some of this stuff, accrual accounting in terms of the deferrals and accruals. I just went over that in the previous edition of this. But we didn't really talk much about adjusting entries, and that really, again, is something that happens as we close up the accounting period. Then that's where we're recording those deferrals and accruals by making the adjusting entries at the end of the period. And then we do an adjusted trial balance, which incorporates those adjusting entries into the accounts that were affected. And finally, excuse me, we prepare the closing entries upon completion of the financial statements in order to close up the revenue and expense accounts. And as you recall, that income summary account is used to do that. So the income summary account is used to close out both revenues and expenses, and in doing that, it's going to be debited, or I'm sorry, it's going to be credited for closing out the revenue accounts. The revenue accounts will be debited to zero them out. Income summary will be credited for expenses. Uh, income summary will be debited so that expenses can be credited and zeroed out for the next period. So then the income summary account needs to be closed out to retained earnings, basically on the balance that's remaining in the income summary account, which means taking the debit and credit amounts and subtracting to get whether it's an overall debit balance or an overall credit balance. If the income summary has a debit balance at the end of the day, then that means that retained earnings will be debited and income summary credited to zero out the income summary, and that means you've experienced a net loss when debits to income summary exceed credits. Excuse me. On the other hand, if income summary has a credit balance at the end of the closing entries, then it will need to be debited to close it out, and retained earnings then will need to be credited for that same amount, which reflects the net income for the period. So that's a way of confirming the ending balance of retained earnings as well. So that besides what I've already talked about, pretty much takes care of chapters 3 and 4. Moving into chapter 5, things like the multiple step income statement. So here it's very important for you to recognize, for say a merchandising concern, what this multiple income statement does for us and how it's broken down, so that, for example, your net sales minus your cost of goods sold equals this thing called gross profit. And then you have operating expenses that fall after that, which are the things like selling and administrative expenses that go along with running the business. And when those are subtracted from the gross profit, you then get your net operating income. You might have some income tax on top of that, and then once you subtract the taxes out, you'd have your overall net income for the period. And then remember the recording of purchases and sales revenue under the perpetual inventory system, so that each time there was a purchase or a sale, the inventory account would be hit in terms of the amount purchased or the amount sold. For example, a sales amount would involve two separate journal entries under the perpetual system, one to recognize the sale of the goods, and the other to recognize the reduction in the inventoriable goods. So if you recall, when you were doing the homework, those two entries, and you have to be very careful to use the selling price only for the revenue entry, the actual cost of the goods for the entry that debited the cost of goods sold and credited inventory. Now, as we continue to move through Chapter 5, and we also talked, remember, in Chapter 5 about the periodic inventory system a little bit, and the difference in accounting between perpetual and periodic methods, where with the periodic method, you're not computing the cost of goods sold or the ending inventory until the end of the period. So you don't have a separate entry that affects the inventory account every time a purchase is made or a sale is made. Instead, and I think we got into this more in Chapter 6 as well, we have under the periodic system, when a purchase is made, we have a debit to the purchases account, if you recall. So under periodic inventory, when we make a purchase, the debit goes to the purchases account, the credit goes to cash or accounts payable. When we have a sale, it's important to remember that we will only have the one entry at the time with periodic, and that's the debit to accounts receivable and the credit to sales revenue. Now remember, with perpetual, you would have the second entry, which would be a debit to cost of goods sold and a credit to inventory. But with periodic, you do not have that second entry because you're working everything out regarding cost of goods sold and ending inventory at period end. All right, so what else do we have to worry about regarding Chapter 5? Well, understand conceptually that perpetual inventory provides better control, obviously, over the inventory than periodic, because you're constantly accounting for your inventory on an hourly and daily basis. However, you should still take a physical inventory at the end of the year to make sure that you avoid not accounting for losses due to pilferage or just spoilage or whatever the case may be. So you should know obviously how to compute, not only compute gross profit as net sales minus cost of goods sold, but you should also be able to recognize how to compute a gross profit rate based on those relationships. Then you should also remember the discount terms for purchases. I might be bleeding a little bit into chapter 6 here. I don't know for sure, but so for example, if you're given a problem where there's a discount terms of 2/10 and n/30, understand what that means. It's 2% discount if paid within 10 days, or you pay the entire balance within 30 days. So you should know how to obviously how to compute that discount amount for taking the discount, and also what that would do to the overall amounts that were due to the seller and due from the buyer. So for example, if it was an $8,000 purchase with a 2% discount, the cash that was laid out by the buyer to purchase that, or the credit to cash, would be $8,000 minus the $160 discount. So they wouldn't obviously owe the whole amount in cash, but they would be able to write off the entire accounts payable amount. So you would have a debit to accounts payable of 8,000, a credit to cash of 7840, and you would have a purchase discount of 160. And remember that this is using the periodic system. That credit would have been to inventory, by the way. Under a perpetual system, a periodic use this purchase discount account, which is a contra purchases account, remember, and so that's why it has a credit balance, whereas the purchases account has a debit balance. All right, I'm going to stop here. So sorry, we're going to do a fourth one that concludes on whatever we missed for chapter 5, and then it goes through chapter 6. With that, we should be